Hello, Brian Turner here with another mortgage video installment. Today we're going to go over some mortgage terms, understanding the process, Mortgage Terms 101. The first thing that we're going to go through is the appraisal. The appraisal is the assessment of the property's value. It's a third party that the bank hires to go out and professionally appraise the value of the property. Next is the APR, the annual percentage rate. This is the total cost of your loan expressed as both a percentage per year and takes into account the closing costs and note rate. So it's a good thing. Next is closings. The closing is the process that finalizes the loan package. Once everything's done, the appraisal's in, you've been through underwriting, everything's approved, you meet at the attorney's office, and they have what's called a closing. You sign the papers, and then there's no turning back at that point. Next is a conforming loan. That is a loan that conforms to Fannie Mae or Freddie Mac's guidelines. We're gonna go over more of that later, but that's when you get the loans with the really low interest rates. It's because it conforms to those guidelines. Next thing is your debt ratio. That's the borrower's total debt compared to their total income, and it's expressed in a percentage. So say for instance you had a total monthly payments of $1,000 a month and your total income was $2,000 a month, your debt ratio would be 50% because 1,000 is half of 2,000. So when you hear mortgage people talking about debt ratio, that's what they mean. Total monthly debt divided by total monthly income equals the debt ratio. Down payment, that's the portion of the purchase price that you pay at closing. So if you're going to buy a $100,000 house and you're putting 10% down, that would be $10,000 that you're bringing as your down payment. An escrow account. In order to get the best rates and terms, it's usually necessary to pay 1/12 of both your property taxes and hazard insurance. These funds are put into what's called an escrow account, and then when they become due each year, your lender pays them. So an escrow account is something you set up with your lender, and you pay 1/12 of your taxes and insurance because there's 12 months of the year and you make 12 payments. And then when everything becomes due, the lender goes ahead and pays them. There's two things good about that. A, you get a better interest rate if you do it, and B, your tax bills usually due at the end of the year, December 31st, which is Christmas time. So it's a terrible time to get a big bill. So I prefer them. Fannie Mae, the Federal National Mortgage Association. This is it's a private agency that what they do is they insure the money that mortgage companies make. So if you make a loan that conforms, they'll insure the loan, and that's why you get better interest rates. One thing to keep in mind, Fannie Mae does not actually make loans. What they do is they work with lenders and make sure there's no shortage of funds available for mortgage loans. FHA, that's a government type loan. The FHA is the Federal Housing Authority. What they do is they guarantee loans by making it easier to qualify. This is usually really good for first-time home buyers because they tend to ask for less money down and they have relaxed underwriting guidelines. So it's good for first-time home buyers. FHA. FICO scoring, that's your credit score. It's basically a calculation that's based on a whole slew of things, but it's timeliness of payments, amounts available on your credit lines, numbers of inquiries, number of open accounts, history of bankruptcies, judgments, collections. All of these things are put into a computer model, and they spit out a credit score. So when people say FICO score, they're talking about your credit score. Freddie Mac, Federal Home Loan Mortgage Corporation. This is a similar group as Fannie Mae. They kind of do the same thing, except one thing they do is they work with multifamily residential mortgages. So they kind of have an extra part on it. But what they do is they guarantee loans. So mortgage lenders can sell their loans to Freddie Mac and use proceeds to fund new mortgages, which in turn increases the money supply to home buyers. The company does not make loans directly to home buyers, but puts private investor capital to work for home buyers in general. Interest. That's the charge that the lenders charge you for using their money. So when you hear about your interest rate is 5%, what they're doing is charging you 5% of whatever you owe as their charge for doing business with you. So that's what interest is. Note rate, that's the actual interest rate charged by the lender on the principal of your loan. Again, that 5% is your note rate, and the money they make off that 5% note rate is called the interest. LTV, or loan to value, is the ratio of the loan amount to the value or sales price of the property expressed as a percentage. It's an inverse of your equity. So if you put 20% down, lenders are going to talk behind the scenes and call it an 80% loan to value, because if you're working mortgages, it's easier to understand that way. So if you ever hear of a mortgage person saying 80% 80 LTV, they mean it's somebody's putting 20% down, or there's 20% equity in the house. PMI, or private mortgage insurance, is in the event that there is a default on the loan. Usually you will pay this if you have less than 20% equity in a property. Rates vary with the risk of the loan, meaning like, is this a primary residence, investment property, second home, is it a condo or a single family residence? That's what it means by rates will vary. While you pay the premiums, there is no benefit to you. It's really just to protect the borrower. Pre-approval and pre-qualification. Pre-approval is a mortgage loan. This is approved at a specified amount factory appraisal on a property. Pre-approval is a little more involved than a pre-qualification. It means that the lenders actually received like the income documents, the down payment verification of down payment funds, and you just got to get an appraisal kind of thing. Pre-qualifying means that you've told them a lot about your information, you've told them about your job and your work and your income, and they've run credit on you. And based on what you're telling them and what they're seeing in the what they're seeing on the credit report, they've pre-qualified you for a loan. Principal is the unpaid balance of your mortgage. So each month you'll hear people say you got a principal and interest payment. Well, the principal is the portion of the mortgage payment each month that is actually paying your mortgage down. Underwriting, the assessment of a loan's risk, which determines whether it gains approval. We've all heard of underwriters. That's what it is. They're taking the whole loan package and looking at it and assessing the risk, and then either going to approve or disapprove the loan. VA loans, Veterans Administration. These are loans available only to active and honorably discharged members of the military. You can have been in the reserves and still qualify for a VA loan. These loans require little or no down payment and are insured by the Veterans Administration. That's it. That's Mortgage Terms 101. Hope you found this helpful. Have a great day.